Hi there, welcome back. Before we do a whole specialization on investment management, it's useful to define and describe the activities associated with the investment management process. This will provide us with an overall perspective for the concepts and the tools that we will be talking about in future modules and courses. Right, so the investment management process starts with setting investment objectives. Whether it's an individual investor planning for retirement, or a pension fund looking to meet its liabilities, or a university endowment, for example, with a very long-term growth rate target, the first step is identifying investment goals. Right? We can express these as either, for example, a desired nominal or real rate of return, or alternatively, these objectives may be liability-driven. In that case, the investment must produce a certain cash flow to meet the contractual obligations. And these investment objectives, of course, should reflect the risk-return trade-off between the expected return that an investor wants to achieve and how much she's willing to assume risk. Okay? So once the investment objective is defined, this will also help us determine what the benchmark, right, or what is sometimes called the bogey, to evaluate the performance of the investment manager. Right? This objective will be used to assess the alternative investment strategies available. In later courses, we will discuss how, for example, an investor's risk tolerance, behavioral biases, right, tax considerations can influence the investment objectives and the choice of the investment strategy to best achieve these objectives. Right? So these are some topics that we will be talking about in the future. The second step in the investment management process is developing an investment policy. Right? So come up with an investment policy that will meet the stated investment objectives. This really is you can think of it as a document that guides all investment decisions. Essentially, this amounts to deciding on the investor's actual portfolio. Right? Typically, an investor may start with all her money in a cash bank account, and then maybe consider how much to invest in something riskier or with a higher expected return. Right? So you can think of this as more broadly the asset allocation decision. Right? How funds are to be divided across different asset classes. And then the next step is the security selection decision, which basically deals with the choice of the particular securities to hold within each class. Right? Finally, the last step is, of course, measurement and evaluation of investment performance. Right? So the last step in the investment management process is the measuring and the evaluation of the investment performance. This involves monitoring the portfolio, rebalancing the portfolio as necessary, and measuring the performance and evaluating that performance relative to some benchmark. So in summary, the investment process consists: 1, setting the investment objectives; 2, coming up with a policy document that guides all investment and portfolio decisions; 3, finally reviewing and evaluating the performance of the portfolio. In later modules and courses, we will discuss in detail the concepts and the tools you will need for each of these steps of this process.